The date is February 7th, 2019. This trade is in Amazon. I'll also share some charts on a Netflix, Tesla, and Nvidia trade. I'm playing this tape at 500% faster than it normally is. These trades took approximately 2 hours and 40 minutes from start to finish, which is really too long for a YouTube video. So we're going to do it at an accelerated rate and get through all 4 trades in about 30 minutes. So here we have Amazon. I entered around 1620, 1619, 18, that area. You can see the circle on the chart. And price immediately started moving in my favor. I took the trade because it was breaking down out of a range. It had good follow through after my entry, which I always like to see. So I went ahead and I added a little bit more. I'm scaling in possibly up to 5 lots. Right now I'm at 150 shares. I added to it as it moved in my favor. Now it's starting to consolidate laterally, which is what often happens after a move. At this point, I'm going to go ahead and split my stops. These are just emergency stops that I have on the chart. I can always exit anytime sooner than that if I don't like the price action. The main way I handle my stops is to adjust them incrementally, logically. I pay attention to the price and trend action. I look at higher time frame charts. As long as price is moving laterally, I don't mind being patient, waiting. I also see it developing into a range that I can use to add to my position at a slightly better price. Or if it should break out with some strength, I can also add there. One of the things that's very important to me is closes. A lot of people jump in and out of a stock in mid-candle. I really consider the highs and low of a candle to be noise and the open and the close to be signal. So a lot of times I base what I do on the closes of candles. This last close we have here on the chart, it's very weak. Some would say, oh, that's a breakout, Heather. First of all, it's a terribly small candle, very doji-like. So I'm not convinced that it's a breakout, and I'm going to hold off on adding to that position. I'd much rather add if I'm scaling in on pullbacks or strong follow through. I also am trading right off the open, which is 0630 Pacific time. So the market's just opened, and I initiated my short entry just a few minutes after the market bell rang. So here's the pullback that I'm looking for. If this stock is going to make a strong move down, then I'm not going to expect to see a really strong pullback. I'm expecting to see a weak pullback that might trap some longs, and then when they're forced to cover, price should fall more easily. I don't use the MACD that much anymore, but I do have it on this chart for you viewers. As you can see, it's an additional tool, a good tool for confirmation to kind of get a sense of the momentum. The moving average lines of the MACD are very far away, which would suggest that it would need more time before reversing. That said, anything can happen, especially at the open, the first hour of the market, first 45 minutes to an hour, I should say. This kind of price action is really boring. It's often the type of price action that will cause traders to choke a trade or to jump in and to jump out and to jump in and jump out, especially if their position size is too large. So use a small enough position size that you can maintain emotional control, and these little ticks here and there aren't going to send you into an intense emotional reaction. Also keep in mind this is 500% faster than what the price action actually was. So it was very slow and very tedious. A lot of times a long sideways consolidation can really wear out traders. You can see prices trying to retest my break-even point for my 3 positions that I put on, or 3 half lots I put on. Nervous traders, people who have position size that's too large, they cannot handle a retest of their break-even point. They would panic out. It's a good idea to have a intraday process that you go through, so you're not just staring at one chart making yourself crazy. Yes, you need to be attentive, but you need to cycle through all the charts in an orderly fashion for all the trades that you're in. Ask yourself, am I seeing price strength or weakness? Am I seeing follow through? Am I seeing consolidation? You want to plan and anticipate what might happen. If I'm expecting a stock to go up, what kind of price action am I expecting to see, or would I likely see? Same for if I'm shorting a stock. You don't want to be a passive participant. You want to be thinking and planning and anticipating. Another great routine for intraday, especially when you're in a trade, is focusing on your triggers. Am I following my rules? Am I following my plan? While it's in this range, I'm a little more cautious about adding, although these last 2 pullbacks to my break-even point would have been pretty good places to add. I always find it easier to add on a pullback than a breakout, because a lot of times breakouts like to retest, price likes to retest that breakout area. So you can see even with the tape sped up, this is terribly boring action. And these are the times you have to remind yourself that you're in the trade to make money. You're not in the trade for excitement. You're not in the trade for any other reason than to make money. Not to look good, not to feed your ego, not to impress someone. This is an excellent example of where you need to exercise discipline. It's easy to be disciplined when a stock's moving in your favor, when a stock's having very short and very shallow pullbacks. But when a stock pauses for 30, 45, 60 minutes, a lot of people start to lose their patience and in turn their discipline. Alright, I'm going to speed this up to about 1500% just so we can get through this very boring price action. But remember, being patient is part of being disciplined, and being disciplined usually pays off. You want to follow your triggers, you want to follow your strategy, you want to follow your plan and your methodology. Don't give in to boredom or impatience. Wait for your signals. Okay, looks like price is moving up. If it hits our stop, that's okay. We haven't taken on too much risk. If the trade were to be lost right now, I think it would still be under about $500. Usually I like to try to keep my risk around $500. But you can see I'm not panicking, I'm freaking out, I'm not grabbing the stop and making it further away or closer. I'm just giving the trade time to work. I'm letting price action tell me. Alright, I saw some hesitation there. I saw a nice push above this little range. I think it's going to trap some traders. I think it's going to trap some longs that are thinking that there's a breakout from this range. Resembles an ascending triangle a little bit. I think it's going to trap some players. I'm going to use this as an opportunity to add to my position. I'm going to leave my stop where it is. So it's a very small risk add-on. All right. Added 150 shares. The price is roughly between my first two entries. So I'm up to three lots total, 300 shares. And now I'm expecting to see some action pretty soon, one way or the other. I'm either going to be knocked out. I've added to my size, but I haven't added significantly to the risk, which is exactly what I want to do when I'm trying to leverage myself into a trade. I really like where my stop is. It's not in the obvious area that the market maker would try to hit, which would be the third candle after the open, the first candle after my first entry. A lot of traders probably had their stop right at the top of that wider range candle, and they just got dinged out. So again, patience. Now we're seeing some movement. Some long traders, their stops are getting hit as price pulls back, which helps fuel the downside. I like the strength of that rejection. To me, it looks like it's just getting ready to really let loose. And so I went ahead and I added another lot on the candle down. It's important not to get a myopic perspective. You want to look and see what the market is doing. On the chart, I have the 60-minute chart, the 3-minute chart, both of Amazon. Then, of course, the time and sales and level 2 for each. And then below that, I have the SPY, which is the S&P 500 ETF. What is it doing? You can see it's falling. It was in a range also, and now it's starting to let go. Check, look and see what the other stocks in your basket are doing. Look at volatility. Is it rising? Is it falling? What are the catalysts for the day? Does Amazon have an upgrade or a downgrade, or is there a bit of news about it? Any kind of exogenous event that can move a stock is something you want to be aware of. Do they have earnings? So I've added another lot, my final lot. I'm up to 5. I've also got the market falling. I'm trying to stack the probabilities in my favor. I've been able to add to this trade without adding excessive risk. And as I've said before, where my stop is right now is simply an emergency stop. If I don't like what I see, I can always tighten it up. Also, now that I have a full position, I'm going to split my stops to further reduce the risk. I'll manage one aggressively and the other more patiently. Also, by splitting my stops, it's allowing me to tighten one and reducing my risk on the overall position since I'm trading larger position size. The longer this range lasts, the more it's going to shake out the weak hands. The market has a way of either wearing you out or scaring you out, especially if you don't have discipline or you're an emotional trader. By splitting my stops, I can manage one very aggressively, and you see that I am. Sometimes I use the 1-minute chart to help me adjust my stops when I'm being very aggressive. But at the same time, I am trying to give it room to run. Even while adjusting my stop aggressively, I'm trying to do it incrementally. Right now, the general market is starting to let go. I expect that Amazon will follow. along with several other stocks. It's attempting to move into new lows. And there it goes. Now follow through will be key. I have my maximum position size, so I'm going to try to scale out into strength. And now as the stock starts to move in my favor, my job is to watch the price action, look for strength and weakness, look for follow through, look for hesitation, to manage my stops according to my methodology in my repeatable process. Price is starting to near a potential support area on the 60-minute chart, this little yellow line that I have here. So I'm really watching price action to see if it's going to start to slow down or accelerate, how it's going to behave as it approaches that area. So far, price looks pretty good. I'm putting a tighter stop for a quarter of the position on, and it gets dinged. The price action isn't as strong as I thought it should be for a down move, for a downside breakout after a very long horizontal consolidation. So I got very aggressive with the quarter. Now I have booked some profits. From a psychological standpoint, I'm glad that I've booked some profits. And from a technical standpoint, I have a little protection now in case there is a sudden or a large move against me as support kicks in near that area. Alright, while Amazon is playing out, I've also been trading and managing other tickers, Netflix, Tesla, Nvidia. I entered short on all of those. I've also split the stops on all of those and have been managing them incrementally. And take a closer look at where I am in those trades. Just need to pull up the chart here. The white circles are entries, the blues are exits. I had a total of 5 lots for Netflix. I exited half the position, and then the final 2 were quarter exits. Nvidia, I entered 2 lots short, added a lot. I didn't like how price was moving, so I exited the entire position. Then the stock hit its head on resistance. I immediately re-entered with 5 lots short. I exited half and then a quarter and a quarter. Tesla, I shorted 2 lots, added 1 lot. Didn't like the price action, took half the position off, re-entered with 3.5 lots short. When I saw price starting to move to the downside, my exits were the same as the others, with half off, then a quarter and a quarter lot. With Amazon, instead of doing 2 lots, I've split my position stops into half the position and a quarter and a quarter. I'm running the first 2 quarters very aggressively because I'm not seeing any follow through to the downside. I don't like the price action, and I want to lock in some gains in case this reverses on me. If the stock starts to trend down, I still have half a position, so I'll be able to participate in that run. But I'm taking a little bit of risk off the table. The stock has moved in my favor, and now it's stalling out. That's not the kind of follow through that I like to see. I'm going to speed up the tape to 2,000% faster than price action really was. That gives you a really strong indication of just how slow and tedious price movement was. And just circling my exits so I can keep track of my trade. And while I did that, the other quarter position got stopped out. I'm perfectly okay with that. I don't mind locking in some profit when price is not behaving the way I think it should. I can still be patient with my other half. Even if price were to move all the way up to my current stop and take me out, this would still be a profitable trade. So there's no reason to panic out of the other half. There's no reason to ratchet the stop down and try to choke the trade. A lot of times people talk about discipline and how important discipline is, but very few traders actually take the time to define what they mean by discipline. From my perspective, discipline is patience. Having the patience to wait for something to set up before you get in, for your triggers to give you a signal. Patience to manage your stops according to your repeatable process, to manage them incrementally, thoughtfully, to use intelligent position sizing, to scale in and scale out of a trade. Discipline is also focus. If you're in a trade, pay attention to your charts. You're not off looking at YouTube or some social media. You're being attentive to your process. You're following your intraday process. You're cycling through the stock charts for the trades that you're in, adjusting your stops, looking at the technical information on the chart, doing your routines. That's all part of discipline. Another important aspect of discipline is not overtrading. A lot of traders don't understand how to trade ranges, and they don't understand pullbacks within the context of a trend. Take the time to identify your weaknesses and to work on them, to make them your strengths, or to, at the very least, mitigate the negative impact it has on your performance. One of the biggest obstacles with ranges are people tend to jump in and out and in and out, and they get chopped up and they lose a lot of money, and in the process they end up over trading. Plan in advance how to protect yourself from these common pitfalls. Right now, as I watch price action, I'm asking myself if price is going to retest that prior swing low that we had earlier that occurred on the first exit, right about here where this line is. Will that act as potential support, or will it break out and break down below it? I split my stops because I see stalling, and to me that looks like support is kicking in, and price looks very tentative and unconvincing. And the stop is hit, another quarter of a position is taken off. Good stop management is a balance between locking in some gains and also giving the trade room to run, which is why I split my stops. And I've just adjusted mine down because I don't like the price action. I'm seeing some support and buying come in, so you can see that I moved it down. And now I'm moving it a little tighter as I see follow through to the upside, a little more aggressively, a little bit more. My objective is to give back as little profit as possible since I don't see any follow through. And the final piece is knocked out. Overall, a pretty good trade. The best exit was for approximately 20 points. These are the annotated charts of the trades I made for the day that I posted on my website and in the chat room. The white circles are entries, the blue circles are exits, the purple lines are initial stops. You can see how I scaled in and scaled out of the trade. Rather than calculating the profit for each individual entry and proportional exit, I usually just note the best exit. Another way to do it is to take your cost averaging for your entries and your exits, and then multiply that by the number of lots. If your average exit yielded a $20 gain per share, you multiply that by 5 lots. That would give you 100 points for that trade. I usually trade 4 to 10 stocks at a time. Here are a few other trades I made. This is Netflix. I scaled in 4 times for a total of 5 lots, and I scaled out with 3 exits. My best exit was 7 points. This is Nvidia. Originally I entered with 2 lots, added 1 short. I didn't like the price action, so I exited the trade for break even. Then when I saw it encounter resistance with a small risk, I entered aggressively with 5 lots and also scaled out 3 times on this as well. The next stock is Tesla. Similar to Nvidia, but different. I took 2 lots short, added a lot, and when price started acting poorly, instead of exiting it completely, I took half of the position off. Then when it started to gain some momentum to the downside, I added back 3.5 lots short. The first exit, I took 2.5 lots off as it moved in my favor. The first quarter exit was beginning to look a little extended, so I locked in some gains, and then once I saw the higher low put in, I took my final exit. If you'd like to learn more, I have a lot of free educational material on my website. I also share more trades that I've made, as well as lessons that I've learned regarding success and failure, trading weaknesses, and my top 10 trading rules. There are also a lot of helpful resources and links. Until next time, good fills, everyone.